that as of last week's jobs report and the recent ECI, we are actually seeing the first contraction in this coincident employment index. If you compare that to what happens in recessions, you can see that pretty much the only time ever that this goes into that contraction territory on a coincident basis, we get a recession, and we get it like very, very quickly soon after. We saw a downside surprise in non-farm payrolls, but it was still positive. We weren't losing jobs yet. We still have not seen a month where we're losing jobs. We're still gaining jobs. So it's hard to make the argument that we're fully in a recession right now. Hey everyone, want to give a quick shout out to our sponsor, Polkadot. Bolstered by the largest community DAO with 1.3 million holders and over 1,000 proposals passed, the Polkadot chain is a network of networks that's powering over 500 applications, innovating on the future of finance. You'll hear more about them later in the show. Welcome back to another episode of On the Margin, Roundup edition. This week we just got Quinn and myself, but Quinn, in honor of Tyler, has decided to wear a Tyler type shirt this week. What's going on, Quinn?
Hey, Felix. Yeah, it's good. It's good. I'm glad it's Friday. Feels like the worst of the vol is behind us a little bit. But yeah, I'm sporting Tyler's. When I saw him in Texas, he gave me his wife works for a clothing company and hooked me up with some of the swag. So in honor of Tyler's absence, I'm wearing his shirt.
Yeah, somebody had to pull out the sun shirts that are for 5-year-olds when they're at the pool all day to not get a sunburn. So watching out for the sun and the UV rays for you, Tyler.
Yeah, exactly. I feel like a toddler right now.
Yeah, man, it's been a hell of a week. We obviously had a lot going on in the markets. The last time we talked, we actually recorded this recording on Thursday afternoon, which was basically right before all the markets unwinded, and we published it on Friday, which was just basically in the midst of the chaos. And then that chaos continued after the weekend. We saw a bit of a crypto, low liquidity crash over the weekend that continued on into Monday, into like really the meat of the move. And, we saw the third highest print on the VIX ever on a Monday. That was very surprising to me, but also somewhat not surprising to me. I just want to do a little bit of like a debrief and post-mortem of some of the things that we've been talking about over the last month and a half or so, and some of the things that we were right, some of the things that we were wrong. And, Tyler was talking a lot about a month and a half ago about what was going on in Japanese banks, like Nori-Chukin, if that's the way you say it, and some of these dynamics and stresses that was undergoing there. And then also looking at some of these FX moves that were starting to happen and just how disconnected they are getting from, historical correlations and fundamentals. So, this is from an episode a month ago where Tyler was talking about the JP Morgan FX Volatility Index and thinking about how it's going to break to the upside significantly. And that would cause a lot of stress and pressure on the Fed to begin to ease more significantly, or at least jawbone the easing. And then we also talked about this chart was really, really great from Andrew Steno-Larsen that really flagged for me what was potential for this dislocation in markets. It's just, if you rewind to early July, the US yen was trading at just over 160, and that was very dislocated from real rate, like five-year real rate differentials, so rate differentials. And we had talked about how it felt like this momentum and trend that we've been seeing is sort of getting fully pressed to the other side, and then we're going to see a pretty hard reversal soon. So, we were pretty correct on that side, but then there's obviously, the idiosyncratic events of what can happen during these correlation to one moments. And those are really difficult to time perfectly. So, if you're trading a low time frame, sometimes you can be caught off guard. I know Quinn was pretty lucky that he had a wedding planned on Friday, which led him to de-risk, fortunately right in time. I wasn't quite so lucky, but saw some things that, triggered some risk management for myself. So there's a little bit of knowing what could happen, but also having to react and being somewhat, flat-footed. So that was the precursor leading up to this event. As we've been, I think this is the third week in a row that we're looking at this chart of dollar yen to the Qs. And we've been talking a lot about how the yen carry trade dynamics underlie a lot of the flow into Qs and US equities. And so as that has been reversing, we've seen the Qs come lower quite significantly. And the really interesting one for me is just looking at This was a really great chart that got posted during the heat of the moment. And just looking at a regression between the VIX and credit spreads. So VIX is obviously the index of volatility based on S&P or SPX options about a 1 month out. Credit spreads being the risk of or the probability of default on fixed income instruments. So generally speaking, during like a true recession crash like 2008 or 2020 as well, you see credit spreads widen out significantly at the same time as vol is getting unpinned at the same time that equities are coming lower, because the risk of recession is increasing dramatically. The risk of potential default is increasing dramatically because the equity value of these companies is being marked down significantly. So normally you see these pretty tightly, the R squared in this regression is pretty solid, just from like a quick visual look. So what we saw though is that, this little red dot just shows just how muted the move in credit spreads was versus the move in VIX. So that's a really interesting telltale for me that this was a market structured, market participants that were just over their skis way too deeply at a moment that was really unfortunate, and just like way too pressed into these specific positions, way too crowded. And we just seen the mother of all flushes over the last week. There's a couple other charts I want to get into, but just want to pause and, get your take, Quinn, on if this is how you saw things sort of play out as well. Yeah,
it's, I think, everyone's obviously like triaging, and, the fact of the matter of these situations is at any given day, the market's open and trade, and you have a probability distribution of outcomes. And these type of events, for a reason, live in the very, very far left tails with very low probabilities of occurring. But when they do occur, they're very convex and, have big ramifications. So they're tough to predict. I think you can use different macro tools and analysis to maybe assign higher probabilities to environments that they can occur. But, there's probably zero people, who were calling for the specific thing, and even if you did, the specific knock-on effects. So I think it's an interesting case study. And the other funny thing I always like is when people are like, oh, well, this is like the perfect example of when Bitcoin and crypto should perform. It's a broken asset class like that. It also sold off. And like, that might sound good for a talking point, but there's one market that's open 24/7 through, closed hours, weeknights, and all through the weekend. And that's crypto. And so if as everyone's doing their analysis, getting really kind of panic feared up over the weekend as they've had time to review what's actually happening under the surface, there's one thing you can sell, and that's your crypto holding. So in these types of events, even gold, gets sold off because it's another asset on the books that you need to delever, degross, and raise cash. And we saw a pretty violent bounce back after the deleveraging was over, but there's just no asset that gets spared. And honestly, that's one of the signs, right? Super high volumes on a big sell-off day tend to mark bottoms. When everything gets indiscriminately sold, those tend to mark bottoms because people aren't selling what they want, they're selling what they have to. So these are all signs you look for to fade and hopefully pick the other way.
Yeah, the gold one was super interesting to me when I was looking at markets on Friday, and we were starting to see that pain in the core market stressor points like the Qs and that was being affected by this yen carry trade unwind. And I remembered, GLD was up 0.5% into the day, and then suddenly just like at around lunchtime, when the risk managers come out and you get the tap on the shoulder, just like 0.5% down 1%, like in minutes. And I was like, okay, the margin calls are coming, and they gotta lower their VAR, and they're gonna cut anything. So to see that, I was like, okay, we're in this VAR de-risking mode. And that led to me to, basically try to front run that VAR de-risking in a way, and cut pretty quickly, because it's like, okay, if they're not sparing gold, then anything's on the table.
Yeah. The other thing I'd point out about these events are the timing of them. So it's no coincidence that when you go and look at like Bitcoin price charts just because it's the most volatile asset. That you could do this with stocks as well. But it's most obvious in Bitcoin price charts. Notice before every big run, it's like a trickle down, big capitulation down, big reversal, trickle, big down, big reversal. And that's just that's just kind of like how things have to play out when the reason these assets bounce and these bull markets continue and risk assets stay risk on is because typically of this accommodation from monetary policy officials or government response, whether it's fiscal or monetary. And those don't come without the fear event, without the panic event. We've seen this now. It's like every 6-ish to 9-ish months, every year for the last 4 years, there's these recurring themes where liquidity's good, the market's rip, economy heals, things deteriorate under the surface, liquidity falters, and it's just kind of like a slow bleed until that big capitulation that then spurs and incentivizes government action. So
yeah,
it's like it's always the hardest, right? Too, because you're like, okay, we're getting so close to this liquidity, and in the fall, the Fed rate cuts, the global rate cuts, Chinese liquidity, and then there's always that one last event to shake everyone out before you can really get that actual upward movement.
Yeah, it's so true. And like this is just a chart of implied correlations index, which we were flagging when it was at 7, just how scary that was, and just how like one-sided the market was. And you can see, again, this tracks the basically the implied correlation between like index and single stocks. And as this whole thing happened, you always hear people talk about, okay, we're getting this correlation to one moment. And it's driven by these dynamics that we just talked about margin calls, about like, VAR degrossing from institutional flow and that sort of thing, unwinding of market neutral trades. This all happens at the same time. And then you see correlations increase significantly. So, we were at a 7. And then during that Monday, I believe we hit all the way above 70. So that's just like hugely positively correlated, and pretty much nothing is being spared. Hey everyone, this episode is sponsored by Polkadot. Polkadot relies on its community to drive decision making and shape the future of the network. All 1.3 million DOT holders are able to share their ideas, vote on initiatives, and approve funding. This sponsored message, for example, is actually voted on via the Polkadot community. The Polkadot chain is a rapidly growing network of applications backed by shared security and also backed by $6 billion in shared economic security and able to seamlessly communicate with each other. Without getting too deep into the weeds, Polkadot is working on a whole bunch of innovations. For example, there's the newly released Async Backing, which improves block production and reduces latency, and also Coretime, which gives the ability to acquire bulk and on-demand Coretime and dynamically allocate it. Finally, there's Jam, which is a new version of the Polkadot chain that will push Polkadot's capabilities beyond the current boundaries of Web3, while making it possible to deploy a broad array of technologies to Polkadot. With Jam, groundbreaking scalability that is currently only seen through rollups will actually be able to be brought to the consensus layer. All right, back to the show. At the same time, too, this was a really great chart from Tier 1 Alpha, just looking at basically a regression of the change in VIX to the change in S&P 500. And just to show how aggressive of a just like change in volatility this has been. We have basically that Monday and then the Tuesday in terms of VIX change to SPX change. So we saw one of the highest relative prints of VIX to change in SPX. And then the following day on Tuesday, we saw it go in the other direction. I think at one point VIX on that day was like it hit 65 or something like that. It was down to like 24 by the end of the day on Tuesday. So, if you compare VIX action during a time like 2008, it takes a long time for that volatility to heal that far down that quickly because of the economic fundamentals that are occurring underneath. This has been mostly market structured events. So we just saw this volatility unwind just as quickly, just like a really, really crazy outlier event on both sides.
Yeah, it's across the board. It was like, that's why these events are so shocking. It's how quickly and volatile they become.
And that's the thing is like, it's easy to look in hindsight. Like we're doing a lot of hindsight look right now. Obviously like it's, I definitely didn't predict any of this happening on a Monday. But you got to react to it and then look at it in retrospect. But again, like if you try to hedge that, like, you see people like, Nassim Taleb is always talking about like running a tail hedge book for basically these left tail risks. And that's all well and good, but it creates a significant drag on your portfolio performance. And you have to balance the risk of and the bleed on your portfolio to make it all up in basically one day and know that you're going to top tick the VIX. Like, I don't even know how many people actually were able to, if they're long vol into this, if they sold above like VIX above 60 and you can prove it to me, I will buy you a drink. Like, very impressed, because I doubt many people were able to do it.
Yeah, the VIX is a tough product to trade, especially from a retail perspective.
Totally.
It's not a money-winning objective.
Just a couple other ones to show here, just in terms of this this postmortem debrief, is just looking at how unhedged markets were going into this and how overly hedged they are now. So this is basically this healing aspect that we're talking about that needs to occur now, is that the market is very, very hedged in terms of just like a percentile rank. And we need to see that slowly come down for the market to be less short vol, for markets to normalize as that implied volatility normalizes, as the VIX normalizes. But in that meantime, this is why we're seeing such like wild, big swings in the market right now.
Yeah, I just tossed it in the next chart slide. I just tossed another one I saw this morning is of the put call index is the highest since we had the big April kind of war interest rate scare sell off. So these are just all signs. They're conditions. Tom McClellan always says that when he posts his technical indicators. He's fantastic follow, but it's always important to note these are not requisites or things that require immediate change or effects. They're conditions, and you look to kind of stack up a number of these conditions that might be uncorrelated or differentiated that can give you a sign to start positioning the other direction.
Yeah, I like that. This also shows just like how you need to be, if you're going to be buying puts as like a hedge or something, you need to be doing this before the move, because now like I haven't looked at skew, but I imagine like these puts are just like, in terms of their implied volatility, are just like pretty overpriced. And if you're trying to buy the long puts after the move now, like even if you're directionally right on the delta, like you're going to be just like fighting an uphill battle against that IB crush.
even long calls. Monday morning, I was sitting on cash and was like, I want to buy some of these dips, and it's actually a losing proposition to buy dips on calls on call options, because the implied volatility is so high. You get the big V reversal bounce back in delta, but the vol decay, and you're flat on the calls, and you're like, what the heck? I just took all this risk for. So those are, it's important when you're trading in these markets to understand what that vol structure means. And even in a normal environment, when you're looking to structure a trade, another example is had some long oil calls on, or even if you did this with stock, if you did stock replacement where you sold your stock and bought calls, and it happened to time it decent, you actually broke even. You kind of, or maybe slight decay in the delta of the call option, but your implied volatility went up so high that you weathered most of the downturn without a big loss. So pretty interesting dynamics under the surface when you dissect these different instruments.
Yeah, totally. Just a couple other charts here before you move on, just fully debriefing. I was keeping an eye on central bank swap lines. There's this misconception in markets these days that the U.S. Fed needs to turn on the swap lines, or they need to, open them up to, say, Japan if they were looking for U.S. dollar stress. But after 2020, we've moved to this regime of standing swap lines. So they're just available weekly, and any central bank can tap them for U.S. dollar liquidity if they need it. So this came out on Wednesday, and it just shows the activity, and pretty much only liquidity swap that occurred in central banks was between the U.S. and ECB. And at that sort of size under the amount tab, it's not really all that relevant. This is like tiny size when you're talking about central bank liquidity. So the main point is, Bank of Japan didn't even show up here. And this really leads into my next point about, this was a really great chart from Cox looking at basically dollar liquidity and this dash for cash. And we really didn't see it through this downturn. So that's another indicator for me that this was really just a market structure event and not as much an economic one, because we didn't see as much of that flight for US dollar liquidity, which basically, in these true correlation to one moments, that's the only thing people really want in these times.
Yeah. The one thing I would say that gives me, and maybe this on the outlook side, that gives me just pause, like so many things and indicators scream that was, we saw the conditions good enough for a bottom, extreme high volumes across equities and crypto, extreme liquidations and deleveraging, forced selling. Like it was, I want to say that bottom holds. And I'm turning pretty constructive. I would say the one thing that I don't have the answer to, but I'm thinking about is when you look forward 1, 2, 3, 6 months, and you're looking to say, okay, we just had this huge degrossing event, and I need to re-add exposure. What do I want to add? That's where I kind of think might still be some digestion in the market, because if I'm looking towards the next 3-6 months, your kind of two scenarios are the economy worsens or the data worsens and the markets kind of are weaker, growth scare increases, or it's generally fine, the data. And in either case, there's still liquidity being added from the Fed, right? So you look forward and you're like, what's going to benefit most from this increased liquidity, where it's either slower growth and more liquidity, or growth's fine, but we still get some liquidity. And to me, that's not AI Meg 7, which is why I'm kind of, but they're the leaders in the market right now. So you see what I'm saying, where it's like, I'm not sure that rotation, we talked about this actually, how there's probably going to be a mean reversion trade in that big small caps, 2 small caps away from big tech. And that has kind of almost completely mean reverted. But I think that the play again is to go back into the small caps, because they're going to be the most beneficiaries. So you're almost in this kind of sell calls environment for the AI Meg 7 generals. Everyone piled into those, over allocated to those leading up to the big kind of June, July top. Not that so the biggest thing is those don't have to be going down. The biggest thing is they just have to be kind of neutral to slightly up, to not drag the rest of the market down. So that's what I think could require some chop here. But my bias still, I think, is towards those cyclical stocks and away from the Meg 7. Some of them, I think, from a value fundamental perspective, probably are getting pretty attractive. They're just growing their earnings tremendously. But when you look forward to who's going to benefit most from rate cuts, it is that there's a reason that violent small cap rotation occurred in the first place.
Yeah, I mostly agree with that. I think a lot of it comes down to your call, and we're going to get into this in the show here in a second. But a lot of it comes down to whether you think we're going to be in a recession or not. Because if we're going to be in a recession, low quality small caps have a higher potential for default versus high quality, mega cap stuff. So a part of that analysis of whether you want to be going long IWM or long Qs depends on your decision on where you think we're going to be going. Because yes, rate cuts help, but it also can take a bit of time for that to trickle in too. Just to wrap up in terms of where we stand today in the markets, the last thing, I've been harping pretty heavily on Twitter over the past week of looking at credit spreads for signal of what's actually happening. And this is just a really great chart from Rose I and Alex Campbell, who I actually just interviewed yesterday. It was a really awesome conversation. Excited for that one to come out. But he's been doing the same thing of looking pretty closely at credit spreads to get signal about whether this is a market structure, volatility machine event, or is it an economic machine event. And what we find is that investment grade and high yield credit spreads did go up this week, but it didn't go up, enough to say, okay, the Fed needs to emergency rate cut. On Monday, there was talk about we need a 75 bips intermediate cut, which was on CNBC. That's the shit that they were yelling about, which is just the craziest thing I've ever seen. Especially because a significant rate cut would only make the yen situation worse. I think it's just a lot of bag bias or grabbing a headline or something. It was ridiculous, but I'm glad to see that trick like settle down now, because credit spreads are not saying we need an intermediate cut.
Yeah, that's the bear case here. I would say is that the Fed is overly dismissive of this market move, and I think that's where a lot of the debate is right now. When you ask people who are Fed watchers, who are market practitioners, arguing over 1, 2, 3 cuts, 25, 50 in September type things, is how much they believe that the Fed takes into account market movements and the wealth effect of equities and things. So I think there's some pretty good takes. Like Jem Carson is one that believes they're paying more attention to that than people think. And then you have like Andy Constant, who thinks that they don't care so much about the markets, maybe only in extremes. We'll see. It'll shape up to be eventful.
Okay, so for this next part of the show, we're gonna have a little fun here, and basically, I'm gonna steelman the recession argument, and Quinn's going to be talking about the no recession growth rebound argument. So we've both set up some charts and a bit of a thesis here that we're going to play out. So we're going to bounce that off each other and just really try to steelman each other's arguments and see where that takes us. So I'm going to let you start, Quinn. I've got your slides started here. Take it away, and then I'll take over after.
Yeah. So the first is just acknowledging that we are in a slowdown. We were running 8 to 10% nominal growth, and now we're running 5, 6-ish% nominal growth, and that's huge change. And it even feels probably a lot more given the real growth is GDP, because there's inflation baked into that. So one of the side effects of such large fiscal deficit spending is the crowding out of the private sector. So I think it's extremely prudent to say and fair to say that there's a slowdown. Maybe even you could use the term recession or approaching recession in the private, productive sector of the economy. But the reason it's causing so much confusion is because job growth is still okay. Real GDP growth still is okay. And it's this kind of like 2-speed economy. And this chart, it's a little dated. It's from April. But I think it shows the point, which is 2/3 of job gains over the past 2 years since March 22 have been in 3 sectors: private education, health services, government, and leisure and hospitality, which government, private education, and health services are kind of the same, given so much how much they all are funded by the same entities. And so that kind of shows this crowding out of government jobs are growing, private sector not as much, and who are small and medium-sized businesses, the small cap, the stock indices, Russell 2000, those are these other 1/3 that make up a big chunk of the economy, but they're not growing. Next slide is shows that in detail. So this is the percentage year-over-year employment change between private and government employment. We're at the highest levels since COVID, March, basically, and when the government just is handing out free money and jobs to everybody. But this really started in 2022, the big increase where you definitely had a slowing from. It's impossible to not slow from the fiscal deficit spending levels we were at. And the effect it's having. And we talk about this like 2-speed economy where what the Fed's method for tightening monetary policy has, and really the Treasury is also complicit here, but it's by using just the short-term interest rate and not allowing any tightening of the long end yield, it's created this dichotomy and picked winners and losers in the economy. It's picked the large cap, negative net debt, large tech companies who don't have debt, who have cash on the balance sheet earning, and the wealthy, individuals who are earning that 5% interest rate on their short-term, funds and cash. And it's made losers out of small, medium-sized enterprises, lower middle income workers who don't have as many assets, and the wealth effect has not benefited as much. So that's where you're seeing this massive, the private sector is getting crowded out by this massive government spending. going to the next. So that kind of gives you a picture of why it feels like there is a slowdown, because there is. But the difference that I argue is that there's a difference between a slowdown and a real GDP recession. And even if there is a real GDP recession, it's likely to be still a nominally growing GDP environment due to the inflation environment we're in. So a couple other ones that just talk about on the housing side. So you look at this recent mortgage origination totals. I thought this was interesting. I mean, an absolute decimation in mortgage originations, and so this includes both refinancings and new purchases. On the next slide, it shows a chart of that composition. So in 2020-21, you had just a massive refinancing when rates hit the floor, went to zero. Everyone, basically just termed out free money for 30 years, fixed interest rate in the U.S. And today, there's no refinancings, obviously, because interest rates are much higher than anyone's purchased in the past. So the next chart shows this breakdown of the average mortgage rate and the distribution. So 56% of mortgages outstanding today have a rate below 4%. Only 6% have a rate above 6%. And what we've seen is this huge, kind of over time, as those older mortgages come off the books, the cost of capital and mortgage expense for households will gradually increase over time if nothing happens in the market. And so that's just like a natural slowing effect, but it also puts a damper on new home sales. So on the next slide, I kind of show this number of new homes sold and the average fixed 30-year mortgage rate. And it's kind of small to see, but you can see from 2022 that rising mortgage rate going all the way up to about 7% late 2022. And the effect on, if you kind of go and look at between 22 and 23, home sales weren't falling that hard, because at first that effect of rising interest rates from 1 to 2 isn't that big. 2 to 3, it's a little worse. 3 to 4, it's a little worse. Then you get like 6 to 7, it's like, oh crap, we can't afford it. So you had these new home sales really kind of dive in late 2022, bottoming in 23, which coincided with what we had, the huge government policy intervention in late 22. Rates fell. You can see that in the chart. Rates fell. We got a big stimmy boost up to the middle of 23 that caused more sales. You can see that little bump where the banking crisis happened, last about a month, and then we saw government intervention again, provide another stimmy boost. And then you saw a decline in new home sales all the way to January 24, again, bottoming out once we had that huge 3 to 4 month relief in interest rates after the October 2023 QRA last year, where the Fed said we're not going to issue coupons, and it juiced asset prices extremely. And so this is, the effect of how the markets feed through into the real economy, where interest rates plummeted back then from over 5 to like mid or low 4s, and you saw that effect. So you see in early 24 to mid 2024, or Q1 at least, home prices rose again, and then interest rates rose again. And if you extend this forward, we're now down to mid to low 6s on interest rate on mortgages. We've had this huge correction in home sales, and the economy slowing in general. But what's happened? We've had interest rates fall below 4. We bottomed at like 3.7, 3.8 on the 10-year, and that has a feed through stimulus effect. Not only that, but we're getting rate cuts for the first time in 4 years over the next few months. We can argue about how many rate cuts, and I think that's where most people would say, are we going to tip into a recession or not? Kind of depends on and how quickly we get them. But my bias is that, and then the next slide is kind of wrapping it all up. My bias is that when you're cutting rates of any magnitude, likely to see probably, my base case is for sure 1 in September, and probably likely a second. Third, I don't have much conviction in, but 2 rate cuts even doesn't sound like much when you're going from 5.5 to 5% or 4.75. But in a economy where the fiscal's spending 6% plus a year, I think it's really meaningful. And so this chart just shows the change in mortgage rates year over year percent inverted. So blue line, light blue line going up means mortgage rates are falling, and then what mortgage applications do. And it's obviously if, pulled forward here implies there's going to be an uptick in housing. We haven't seen it yet. So, I think that will be pretty closely tuned in to decipher, recession or not. But banking on the last, 3 or 4 of these little mini slowdowns that we've had within the cycle, the data should follow. So I think, like I said, we get at least one, probably two. The more important thing I'm looking at besides the September, whether it's 25 or 50, my base case is 25, is the dot plot, because you're getting to a point where when the Fed was giving dot plots in March and June and saying, we think this many rate cuts in 24, everybody knew it was back half anyway. So it's like, finger in the air. It might be 1, it might be 3, but it didn't really matter. Like there wasn't that much importance on those dots. But now here they are in September, giving rate expectations for the next 3 months with meaningful cut hopes and deliberations. And so they can't come out and say, we expect 4 cuts in September and only deliver 1. They guide with, multiple months. So I think the dot plots in September is going to be really, really interesting.
Yeah, I think that's a good flag too, that a lot of people will look at, Fed forward guidance and say, okay, rate cuts are priced in. Like when we actually get it, nothing's going to happen. But something I've been harping on a lot is that when you look at how floating rate debt for companies is priced, it's priced as something like SOFR plus a risk spread. So SOFR is anchored to Fed funds rate. Therefore, it can't actually lower until the rate actually lowers. So long term, as you just looked at in terms of like mortgage dynamics, that can happen through natural easing from lower yields, which leads to like this refinancing cycle that you're just talking about. But on that short end for like floating rate debt, you actually need the cut to happen for those floating rate loans to come lower.
Exactly. Yeah. There's and the psychology components, right? You see headlines splattered across CNBC, Fed cuts rate for the first time in 4 years. Mom and pop check their bank's offer, and they want, or Gen Z, it's Gen Z's buying homes now. And it's saying, well, mortgage rates are down lowest in 1 or 2 years. We need a house. We're having our 3rd kid. We got to buy. So there's pent up demand that gets unleashed. It's not like everyone's sitting there waiting for a home purchase is like waiting for 0 rates again. They're just waiting for some breath of life and like relief from the 7.5%. So that's why you get those reinflections.
Yeah. So a lot of your argument is like, looking at housing as the business cycle, as they say, and because of this hyper financialized dynamics, these lower rates are already going to have an easing effect on things like mortgage.
Yeah, exactly. I think we're just in a different environment where, from in the 2000s, 2010, or let's just say 2010s to the early 2020s, it's like rates are 0 to 2%. Like, I don't care if the rates move 50 bips. It doesn't matter because I just know rates are 0 and the Fed told me rates are 0 for forever. Car, home, whatever. Now it matters. Now it's like, it's the difference between can I make my mortgage and living expenses or not? And, on top of that, you've also had house prices come down, provide some stimulus effect for new buyers, and you get activity. So I also like employment. I get the SOM rule stuff. I think that, we're into a point where it's negatively convex, where, extreme deterioration from here is worse than what it would have been 6 months ago. So I'm cognizant of those factors. And I think it's this like 3-month period in my book where it's like, does the Fed deliver enough in this kind of window of, trouble, or, do they push it too far? Not enough stimulus, market kind of melts down again. But then I think on the other end, it's like, man, some nice looking liquidity. Just survive and don't get smoked in the process.
Yeah, the labor one's a good trade off because that's where a lot of my thesis lies. So I'll get into mine here now. The Fed and Jerome Powell in his last meeting, I didn't count how many times he talked about the employment cost index, but it was a lot. He is looking at this very, 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 deeply. It is the core driver of a lot of the underlying drivers of their policy because it gets reflected in things like growth and inflation. So, one of the if you look back at when that true pivot to hawkishness occurred in late 2021. It was actually when risks of a wage price spiral started to take hold and inflation expectations started to get unanchored. So what have we been seeing over the last few months? We've been seeing this ECI, keep missing to the downside and roll over. And that's the top line look at what's been going on. But digging in deeper to it, these are some really great charts from EPB research from Eric. And he has this, basically what he calls this coincident employment index, which aggregates a few different indicators into understanding where are we coincidentally on employment. And when you look at this recent trend of like a 6-month annualized growth rate, you can see, around early 2022, this was around the same time when people started to get really scared about recession. We had negative GDP prints, but they were actually due to these weird dynamics around like net exports skewing the GDP growth rate, but underlying it was very strong. And you can see that here. So the employment cost index was still quite strong at that time. We have been below trend. So this orange dotted line is basically the trend. And we've been below trend for quite a few months now. But as of last week's jobs report and the recent ECI, we are actually seeing the first contraction in this coincident employment index. If you compare that to what happens in recessions, you can see that pretty much the only time ever that this goes into that contraction territory on a coincident basis, we get a recession, and we get it like very, very quickly soon after. And this is like hard data about the labor market. It's not something like a yield curve inversion, which is like a market's forecast, which has been obviously not seen as perfectly correct yet. It's been averted for a very long time, and we haven't seen that recession. But this is, a pretty high signal move that we're seeing this negative contraction now. You compare that with what's been going on with non-farm payrolls. So the jobs report that came out last Friday, and we saw a surprise increase in the unemployment rate. We hit 4.3%. That got market really scared about recession. We saw a downside surprise in non-farm payrolls, but it was still positive. We weren't losing jobs yet. We still have not seen a month where we're losing jobs. We're still gaining jobs. So it's hard to make the argument that we're fully in a recession right now. And this is a lot of what's keeping, Claudia Sahm from saying we're in a recession when she looks at the Sahm roll, is that when you look at non-farm payrolls, like how do you make the argument that, we have either already seen the recession in the past few months, or we're in it right now if we're getting like positive non-farm payroll prints. But when you compare these two charts, you can see that this coincident employment index leads when it goes contractual. Non-farm payrolls follows pretty closely after into the negative.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
And then this is, there's been a lot of talk. We've already mentioned Summer like twice during this discussion, but what the underlying driver of what the Summer tries to capture is momentum in a highly trending indicator. Generally speaking, when the unemployment rate goes in one direction, it continues, and it continues for a while, and it trends. So this was a chart I did of just, let's set aside the summer and look at just like a moving average. This is like a 30-day moving average tacked onto the unemployment rate just to smoothen out the trends a little bit. And what we can see now is that it's ticking up higher. And if you just look at, any other time where we've seen this inflection, maybe in the mid 50s, 1950s, you see like a little bit of a false, breakout to deviation or whatever. But generally speaking, when this goes, it continues. So we've seen the inflection and it's trending higher. And if there's been a lot of talk about, okay, immigration is skewing the unemployment rate. It's making it artificially high. What I find interesting is in the 70s, that was also, that was a big driver of labor dynamics at that time. There was a huge increase in labor supply. And even at that time, we saw unemployment rate trend higher. It didn't do this weird little move and then reverse lower or something just because of an increased labor supply. It's still meaningfully increased. So this is saying that, we're in the very, very early innings of it, and it's going to trend. This was a chart from Mike Green, just looking at and again, this debate about immigration and labor supply. If you can break apart, the data of what is contributing to the unemployment rate. So you can look at new entrants, which is the immigration story about new people entering the job market, but don't have a job yet. And then there's also the job losers, which are what you traditionally think about the unemployment rate, which is people losing their jobs because they're being laid off. As you can see here, the new entrants is, cyclically not that high. It's trending higher, but there's not as much of a contribution from new entrants as there is from in that orange line of job losers. That is meaningfully increasing. So the story is, yes, there's been some noise from immigration in the unemployment rate, but underlying that is a clear and obvious trend about job losers losing their jobs. So that's the unemployment and labor story. We'll shift a little bit into the growth story here, but this is just like a classic 4-quadrant macro map that you've probably seen a lot of different macro research firms use. There's the Bridgewater version, there's a Hedgeye version. This is one from Market Radar, which do some really good empirical research. But basically, it's based on their growth and inflation forecasts, and effectively just to show the change in what's been going on over the last little while. Like back in early 2023, late 2022, when a lot of people were talking about this false start of a recession, we were still in expansion territory under this forecast. Even going into the past 6 months or so, we've been in this more stagflationary environment of still somewhat strong inflation, but the growth wasn't too much falling yet. So we're still relatively okay. And this was led to a lot of, this discussions that we've been having about, fiscal dominance leading to, basically a floor in recession probabilities. But based on their forecast, just looking at like from a month ago when we were in that, sort of stagflationary realm, we've moved all the way out to outright deflationary. So there's been a clear shift in the fundamentals of either that or both the economic and the growth story. Looking at more, leading market indicators, market prices this is the GSCI commodity index. And it's always great to look at commodities to understand what are those forward-looking inflation possibilities starting to look like, and also the growth story. So if commodities are crashing, probably not going to be seeing a rebound in inflation as much, and probably not going to see like a major growth reacceleration. So, I'm not a big TA guy. I'm not a big line drawer, but I just simply put a couple lines on here just to show the potential, support moment that we're on right now. And it looks quite similar to what happened when obviously we had the COVID breakdown. So I don't think we're going to see that much of a crash. That was like totally out there in terms of a move. But, we're right on the verge here. If this breaks lower, this is a pretty clear red signal flashing from the market saying, commodities are coming down significantly because global growth is coming down significantly, which affects demand. Tying back to some more research from EPB, from Eric, this is a really interesting, 3 charts on here where he actually tracks the most business cycle and interest rate cycle, and therefore monetary cycle components of GDP and how they've been affected over the last couple of years. So, when we go through these business cycles of expansion to contraction, a lot of the core GDP components don't actually fluctuate as much as it might look from the surface. It's actually these components like durable goods consumption, equipment, residential, they're the big movers in terms of sensitivity to business cycles. So even though it feels like, we've been at 5.5% on Fed funds for a year or so now, and it feels like there hasn't been that much tightening, especially when GDP is running at 2.9% on the Atlanta Fed at the moment. If you look at the core sensitive drivers, these are coming down, and they have no signs of stopping, especially the durable goods consumption. That's continuing to trend lower. So that to me is telling me that these business cycle sensitive components of GDP are continuing to trend lower with no signs of stopping. So again, like I just mentioned, the Atlanta Fed is at 2.9% right now in their GDP forecasts. And that, there's no way you could really make an argument if we're printing 2.9% real GDP that we're in a recession. But when you look at something like, this was a really great chart I saw on Twitter the other day from, I forget her name, Anna or something, an economist, but she posted this just looking at what happened during the 2001 recession of these revisions to GDP as the recession began. So, this is the thing, is that we all look at basically the initial print of these economic prints, but the revisions come later. And this is a lot of the argument behind folks like Mike Green and Daniel DiMartino Booth, who've been arguing that we're already in a recession. And when the revisions come in, it'll paint the picture that it was actually somewhat obvious. And we've been in a recession for a few months now, but the revisions need to come into it. So when we look at the revisions, what happened in 2001 is initially we were at 2%. And then, after all the revisions occurred following that, we actually ended at negative 1.3% on that Q1 GDP. So how do I know that this is potential what's happening now? You got to start to triangulate it with other components, because this could happen at any quarter, right? But if we look at what's happening with the unemployment rate, if we look at what's happening with the SOM rule trigger at the same time that there's this, you start to triangulate an idea and a narrative that we could be seeing the beginnings of it, and the revisions will make it very clear once that data is more dialed in. So that's the big idea in terms of my straw man argument of recession. And it really comes down to employment in the labor market and revisions as well, is that there's a lot of stuff moving, but it'll become more obvious as the months go on.
Yeah, I think all those points are great. I mean, it's hard to argue with that data. And then where you shake out is, well, the economic side of, if we do truly get a recession, those revisions are hilarious. I mean, it's like everyone, the market moves trillions of dollars on these GDP prints and revisions, and then it's like, oh no, it was actually 3% wrong. So, yeah, I think it just goes to show, like, another funny example is yesterday, right? The market ripping on this like extremely inconsequential 7,000 unemployed, jobless claims beat a weekly data series. Like,
I know,
but you kind of like to say, oh, the market's stupid. That's just never. It's usually like something else going on. I think what I'm trying to decipher most is the economy isn't the market, and so you can have, I think, on the macro side where people usually get annoyed with being overly macro focused is these are very glacially moving pace things, and the markets are much more dynamic and forward looking, to the point where we might be talking about recession, but if interest rates just came down 200 basis points and you look at equity prices and they're off 15%, well, what's new now? So give me the new information. How much does it worsen from here? How much? What's the balance of how much the economy worsens from here and incomes fall versus the benefit of the liquidity? What's that liquidity response? And that's why you often see in these cases, in big slowdowns economically, the market rallies for the first periods of them because there's fresh liquidity, expectations that there will be a rebound, and then how bad the recession is depends on if that's enough. So I think that's the hardest part here, is figuring out, what monetary response is going to be. Is it going to be enough? And ultimately, that's what markets are going to care about. Is everybody has this data? People probably have next month's data from their other models and things. So it's about trying to triangulate what's priced in.
And understand. Yeah, exactly. Understand what's priced in or not. Totally. It's something I've been seeing is people saying, okay, rate cuts are coming. Let me buy TLT, buy the long end of the yield curve because cuts are coming. That's going to be positive for it. But you have to be understanding of what your perspective is on expectations. If you buy TLT right now, you're pretty much betting that we're going below 3% on Fed funds. Like, you're almost betting that we're going back to 0% because the market has all out priced in that, by in a year and a half to 2 years, we're going to be back down to 3%. So you need to be, if you're buying that, you need to be betting on even more easing than that. And that's the hard part of trading.
Yeah. Yeah. And the other part that just you can't stress enough, because everyone's like, oh, you want to make it sound easier than it is, but the reflexivity to all of this. If the Fed in 2 weeks at Jackson Hole could come out with an extremely dovish stance, calm all concerns, point to, allude to more than one rate cut in 2024, and the market's probably off to the races again. That event goes by, they remain hawkish and kind of, closed, market kind of falls off more, muddles along, and maybe you have a really big down event that then spurs more. It's like these things are so reflexive in either direction that feed on themselves. Like that's why it makes them also tough. And you always have to just think in these probability distributions of what's most likely and how do I position my portfolio to what's most likely.
One thing that wasn't spared over the last week as well that we haven't talked too much about yet is crypto. I made the ultimate sin last week where I posted that I said, crypto looks strong here. And, as usual, you wait 20 minutes and then you realize it was just lagging and the whole thing fell apart. But underlying my view of that was that I do really believe that, when this forced selling ends, which it mostly looks like it has, as it's going to be the fastest horse, like Paul Tudor Jones says. During these dynamics, like we're getting very close to the macro environment where he first said that, outright easing cycles. So I am constructive on it, and the market made me look like an idiot, and that's fine. I'll take that on the chin. That's all good. But I want to pass it to you, Quinn, to just look at a bit of like what happened in some of these more crypto native markets of the perpetuals market and open interest. How did it react to what happened over the last week? We did a pretty good in-depth review of the traditional markets, but we'd love to see what did you see happen here?
I mean, this chart is basically all open interest, so all leverage, both long and short positions, dollar value, and you can see pre kind of crash, like end of July, we were like 50 billion ish, and 45 to 50, 45 ish, and the correction in 1 week took us all the way down to 30. So it was like a 1/3 wipeout. That's a monstrous event that doesn't happen too often. It often, at least in a very short term, is a buying opportunity. TBD how the rest of the events play out in the ensuing weeks to know on a longer term. The thing that this doesn't take into account, though, is coins. So, if I have 100 Bitcoin leverage position open and the price nukes, say 20% of those positions are removed and also the price moves minus 10%, then that's kind of how you get to this minus 1/3 number, because measured in dollar terms. So in reality, on a coin outstanding basis, it's not, a third, it's like 20%, but that's still very, very extreme. And you can see takes us kind of back to like early 24 levels. The next slide I put, so that's just crypto exchanges, crypto native exchanges, Binance, Coinbase, etc. This slide is the CME. And so this one is measured in coins and total Bitcoin outstanding open interest. And you can see similarly though, that it was about a 15 to 20% haircut in open interest from late July to start of this week. So very drastic moves. You can see the other ones were July 5th, kind of the German selling, the going back to some of these big sell-off events. So the April one. So again, these are all data points and conditions where you want to look for stacking these edges where, technicals are very oversold, positioning is rinsed out, and there's no more froth, holding key trend lines, things like that. If you're looking for more like a quantitative metric, and obviously the qualitative of what catalysts remain on the horizon are big. The next slide just shows how the magnitude of the liquidation. So this is total liquidations. The red lines on the bottom. Oh, oops, I moved. This one is the open interest dominance. Okay, so this one is. I was looking at the right side. This one is shows the percent of open interest by the coins. So you can see the blue is Bitcoin. You can't really see green. It's ETH, and others is the orange. And so a usually pretty unhealthy sign of market action is when the orange, the alts, non-Bitcoin and ETH percentage of open interest is well into the 30s. So in this case, in March at the peak, it got even up towards 40% of all open interest was non-Bitcoin, non-ETH, which, when you compare the relative market caps of these assets, that's a very speculative level. And in this most recent correction, it's gone below 30 into the low 20s even. So that's an extreme reduction in like the speculative non-Bitcoin and ETH. And you can kind of see there we're back to mid 23 liquidation levels.
Yeah. I'm not sure why it skipped down to that chart, but I think here's the one that you're looking at.
Yeah. No, all good. So this one is the total liquidation. So the red lines there are the total longs that got wiped out in the sell-off. So you can see kind of goes back. The first big red line all the way the far left is in that August 23. So it kind of dates back in magnitude to that event. So and also like early March and the April, the Iran, Israel or Gaza, Israel stuff. And then on the next slide, I just show the total volume across coins, which again, massive amount, particularly relative to the kind of baseline daily activity we were seeing. So all these things, I mean, what are you left with? You're left with a huge amount of leverage gone, particularly leveraged longs. You have a lot of people banged up from being off sides, and a huge volume spike. So, a lot of, if you wanted to trade and transact, you did, and, cleared, and here we are at those prices. And I think, it's very important from here that you're forward looking, right? What happened. If you're on sides, you're off sides. It's not the time to react emotionally to what happened. It's the time to think about what's going to happen next. And obviously we've had an extremely sharp V reversal off the bottom. You could argue that we probably shouldn't even went that low, given just low liquidity environment, midsummer, non-busy hours type of thing. But, you need to be forward looking from here and, like we just said, assess what you think about liquidity, what you think about the economy, and where we might head. So it's hard to have extreme conviction in these moments because they're very uncertain. And the tails seem to have higher
especially in the summer right now when there's just no liquidity. It's just a tough time to take that big view. So I think as always, there's fat pitches always seem to develop every 6 to 12 months. These big trends, when they go in either direction. So don't, if you have high conviction, it's up, like just because you didn't bottom tick 50K on Bitcoin and you had to buy at 55, but it doesn't really matter when, you get those big, good environments. And same to the downside. It's like, look at 21, 22. If you might not have sold at 70, but selling at 60 or 55 is a hell of a lot better than selling at 20. So I think, you want to remove emotion as much as possible and zoom out and try and reassess where we go from here. Yeah, I think that's a great point. Like the fact is that, even like price is so illiquid right now that it has, went up to 62 almost last night. We were down at 49. But the fact is, like, if you're tactically trying to put on a trade, the game board has been wiped. And it's a good opportunity to express your view because whatever it is that you want to express is not as crowded now. So there's, a lot of price gets moved by like these marginal market participants, especially like the high leverage ones. And, it doesn't really get more wiped than it is right now. So it's a good time to express your view, regardless of what it is, I think.
Mm-hmm. Yeah. Just be careful of the illiquidity and don't get shaken out.
Yeah. Maybe wait till September when people are back from the Hamptons and
actually trading.
Yeah. We want to do a little thing here. I tweeted this out yesterday just to get some questions from the listeners that we can, kind of bounce around and wrap up the show with. So, posted a few here and we can go through a few of them and just wrap up the show like that. I think would be fun. I'm going to continue with my trend of humility and pick the biggest trading mistake that I ever made. And for me, it was in 2018, pretty early in my year in my time of trading and that sort of thing. Is at the time I'm Canadian, so a lot of talk was about the legalization of weed or marijuana here. And at that same time, there was a lot of weed stocks that were just going absolutely bonkers. This was by all means a bubble. I was pretty early in my days of this, so I wasn't fully aware of what a bubble could be, and also about how expectations are forward looking versus actual price actions. So I was long a bunch of weed stocks, and I was like, okay, Justin Trudeau's elected. He's going to make weed legal here. All these weed companies are just going to be absolutely soaring. Never mind looking at what is actually priced in and what is expected. And the fact that a lot of these, some of these companies were just almost outright scams, like just their fundamentals were not where the price was. So what happened is that in October, the bill passed for it to be legal, and I was holding a big bag of weed stocks. And I'm like, okay, it's legal. Game on. These are going to go up way, way higher. Like it's legal. I'm going to win. That was the top in the bubble, was the day it was legalized. And that was the day that I learned about buy the rumor, sell the news. So I bought the rumor, but I doubled down on the news because I didn't realize about expectations in markets. And if you just look at, I don't know, like a stock price of like Canopy Growth or something, it was just basically down only from that day. So I got burned pretty hard there, and definitely learned my lesson about what's priced in or not. And that definitely kept with me.
That's a good one. Yeah, it's in crypto, especially with how big of a, you see this more in momentum driven markets, speculative, where it's like the ETF in January, everybody that wanted to buy is bought, and then the news comes in. The top one there, I tweeted at back of this because I thought it was such a good question, but what's the biggest mistake in investing the older generation is making, also the younger generation? I think it's for either of them. I think the answer is just simply the 60-40 portfolio is taken out back, and it's a dumpster fire. Like when I talk about people my age who have 30, 40, whatever it is, 50-year investing horizons, and they own bonds, it's like you just want to shake them, because you're giving money to the US government at 3 to 4%, maybe slightly above now, so they can spend 5, 6, 7% per year deficits, while they're actively suppressing the yield on those bonds to make the interest cost cheaper, and pumping the price of any other productive asset, equities, real estate, gold, Bitcoin, that you can't print. So even my parents, I consistently try to get them out of sovereign bonds, and into, I think the 40 should be replaced with commodities, gold, and commodity linked equities. Those actually are the things that serve as the best hedge. If you look at the environment like today, right, we're seeing about as weak of an economy as you're going to see while the fiscal deficits are raging, high single digits. And what's going on with commodities, they tend to serve as the best hedge, because the response to all of this is more intervention from the governments and more printing of money and keeping things propped up. So that's, I think, and the other one is like, if I wish I don't own a home, but I wish I did, just for the low long-term fixed rate debt. Like if you can get 30-year, like the best assets in the US, I think, are all the people that are sitting on mortgages paying 2% from 2020, 2021, and paying minimum. I think that's just an unbelievable arbitrage.
Yeah.
At a minimum, you put it in treasuries. At a maximum, you put it in risky assets or safer risky assets, or gold and yield.
You basically have a free mortgage. Like,
yeah,
it's crazy.
It's unreal.
Yeah. Wickus is asking about, how much of the yen carry trade has been unwound. What do you think of the deadlock scenario where the Fed can't cut because of the carry trade risk, while actually must cut to avoid a recession? So the second part of what he's asking is that, a lot of this move has been from rate differentials, and rate differentials affect currency prices. So we've seen the yen went up to 160, or, it weakened to 160. Then it's been strengthening and got to like somewhere around 140. And if, there's talk about, we need an emergency rate cut from the Federal Reserve or something like that. If you actually got surprise rate cuts from the Fed, that would actually make that differential worse, because at the same time, the Bank of Japan is actually still hiking interest rates. So what he's saying here is that that yen carry trade would actually get stressed further if the Fed started to cut rates at the same time that the BOJ was still remaining steadfast on their hiking rates idea. Now, at the same time, if they don't cut rates, as we've been talking about through this show, there's risks of recession right now, or at least a growth scare. So if they do not cut because of that reason, it could make for this deadlock scenario is talking about. So the yen carry trade, how much of it is unwound? I saw a headline yesterday from JP Morgan that their estimate was that about 75% of it has been unwound. That feels a bit rich to me, and it also depends on how you measure that. If you look at like notional value of total like capital flows from Japanese into foreign assets, you can measure the carry trade as being as high as like $23 trillion. If you're looking at more like the degenerate components of that carry trade, I could see that most of those market participants that are going to get stressed and carried out have been carried out now. So maybe that's how they're measuring the 75%. But in terms of like that $23 trillion cargo ship of value, that takes a long time. I think that's like a multi-year thing. But in terms of this more speculative bubble components to it, I think a lot of that has been unwound now. So maybe that gives some breathing room. But we saw a couple of nights ago that the Bank of Japan has mentioned that they basically blinked in the face of what was happening, and they a couple folks from the Bank of Japan came out and said that they're looking at the markets. They don't want to hike rates when volatility like this is high, and the market took that as a form of capitulation on their rate hiking campaign. So maybe it was one and done, and this is it. Maybe they lean back towards some form of easing. That creates a dynamic where all global central banks are coordinated in their easing. This is something I tweeted about earlier this week, that creates a lot less stress on the economy because those rate differentials stay constant as that occurs. And that's really the big game, is global central bank easing, which doesn't affect, it affects all fiat devaluation equally. So it doesn't feel as painful because these rate differentials don't blow up. Hope that helps.
Yeah, that's a good one. I think it also depends. It's the carry trade is still working if you got into the carry trade a year ago. So like it's just these last. I like the question from Henry too. As he said, the game theory fund is more profitable to ride the trade. Like, why do people do this? And I just point to all the versions of a carry trade that occur. I mean, why do people eat McDonald's? I know if you eat McDonald's enough, you're gonna die of heart disease. Why do you speed in your car? If you speed in your car enough, you're going to get, enough tickets and lose your driver's license. There's everything is built around probabilities, and the carry trades are extremely profitable for people that deploy them for 99% of the time. And if you're early, you make money on it. And it's psychology, the excesses, the overconfidence, and kind of catching you off guard when you least expect it. Yeah. I think is what ends up correcting these, but they always come back. Short VIX, 2018, all these types of environments, I think.
Yeah, there's always going to be these trades that everybody pile in on. It's just one of many since, if you read the histories of market speculations and things like this, is like the tulip bubble was the same thing. Like, it's literally just human psychology. It'll never end. We'll just find new Ponzi's to play with, really.
So good.
Yeah. Cool. Well, I think
we'll try and answer some of those on Twitter.
We'll try to go through there as well, but we'll do that weekly as well as answer a few of them live here, depending on how in depth the questions are. But it's a fun way to interact and you see, what are you guys wondering about? So really appreciate that, and it's fun to the straw man the recession argument this week with you, Quinn. And yeah, hope everybody has a good weekend.
Likewise. Let's do it again next week.
Sounds good. Hopefully Tyler will be done wrangling all his kids and vacation.
I'll give him his shirt back. I don't think it looks as good on me.
No. All right.
Cool. Take care.